I have often mentioned the fact that as a market participant, you are merely one among a vast array of participants. As such, you're merely a passenger. Because you are a passenger, you have to understand that other participants and the market might have a different idea of where price should go to you. In typical wank speak, I have dubbed this phenomenon the notion of variant perception, the idea that what you do is you assemble your notion, your idea, your trading premise, but at the same time you understand that your trading premise may be incorrect, and if it is incorrect, what are you going to do about it? What I am hoping is that your trading process is linear in nature. And being linear in nature, it gives you a series of binary outcomes. Think of it as an on-off switch. If this happens, do this. If this happens, do that. It's a series of sequential logic statements that drives you inevitably towards a conclusion. That conclusion generally is you either buy something, you sell something, or you do nothing. They're all valid actions at the endpoint of your decision-making matrix. But what is interesting is that vast numbers of market participants do not think in this linear fashion. They think in a very narrative or language-driven fashion. And it is interesting to try and look at what their motivations for that sort of approach is and how it functions. And in doing so, you identify the intrinsic flaws within it. And these flaws are fatal. And I can make that statement with confidence when you simply look at the funds management industry. Because the funds management industry, particularly here in Australia, operates on this narrative or language-based assessment of trading and investment decisions. As a function of that, their performance is always very poor. To give you an example, and this is something I want to walk through because it does highlight some issues, but it also brings into focus the things we should be doing. This is from the Australian Financial Review, and it's a particular piece talking about a series of equities within a given space and what a series of recommendations are for people who are involved in that space. This is the blunt headline: Domino's shares more attractive than Guzman. Morningstar. Okay, fairly decent clickbait. When you begin to look at the article, there's a series of premises within it. And the basic premise is that retailers who've had very strong performance, such as Wesfarmers and Guzman, do not appear to offer value for money. We'll come to whatever this notion of value is shortly. And instead, Morningstar has recommended underperforming stocks, such as Endeavour and Domino's Pizza. First thing we do, when you look at any proposition where you've got a series of data points that you can actually review, is to review them. Because this so far is a story. This is a narrative. This is setting up a premise for me, but the premise has no real data. This is the performance of Guzman. It's a recently listed stock, so I don't have a lot of history, but you can see strong 2024 up until September. Then it drifts sideways and price has drifted off from the high. This is Wesfarmers. Likewise, strong 2024 in two phases. An initial phase that runs through to about mid-year, bit of slack water, price takes off again, then drifts back again. And if we look at their comparative performance for the year, we get a sense of their compound annual growth rate. We can see that for GYG, it's 27.2%. For Wesfarmers, 38.2%. Nothing to be sneezed at whatsoever. So these had been very strong performers over the past year. So we return to this notion. So we've looked at the first part of the premise. The premise is that we first look at those shares that are strongly performing and the ones we're told we should get rid of. We then look at the ones that we're told we should be buying. This is Domino's. It's not all that impressive, and it hasn't been all that impressive for some time, as we'll see a little bit later on. And this is Endeavour, which when I snipped this had suffered that nasty slip from the 470 mark. So a basic premise in summary: sell GYG, earn Wesfarmers, buy Domino's, Endeavour. We need to look at the reasoning. Anytime you come up with a trading idea, it has to have some form of reasoning behind it. That reasoning can be quantitative or technical. To a lesser degree, it can be narrative-based. And in this, I want to highlight the flaws of this notion of narrative, a narrative without data, narrative based upon feeling and language. Their reasoning is what I would call a value premise. As we saw in the paragraphs before, they're talking about their perception of relative value. I'll make a blanket statement. The notion of relative value is a nonsense. The market determines what the value of something is. Your perception of what the value of something is meaningless. There is this notion that things have an intrinsic value that you can understand, that you can apply some metric to. My perception of this is what I would call retail thinking, or a retail form of psychology. So what has happened is the software that allows us to make judgments about products we buy from day to day has filtered through and infiltrated into the investment sphere. There's a problem. It's a false equivalency. They're not the same. I can wander into my local supermarket, and if I see, say, a block of chocolate is $5, and I think that's too expensive, and I come back the next day and it's $2.50, I can make a judgment that it is cheaper than the day before, because the product in and of itself hasn't changed, and the demand for the product in and of itself has also not changed. The problem with a stock is that background notion of the demand for something has changed. So when you have something like Domino's, which has been going down for some time and is currently in an 80% drawdown, the environment has changed. Think of it this way. If I went back and saw that my block of chocolate was now $2.50, but was full of weevils, it may be half price, but it represents no value to me because it's effectively damaged goods. In the eyes of the market, Endeavour and Domino's are regarded as damaged goods. So we hark back to this notion that the only opinion that counts is the market's. Yours doesn't. Your perception is irrelevant. But there is also a profound logic flaw within the notion of what represents value. What represents value for a share? So let's think about this. If I thought a share was fully priced at $5, but still had some value as a company, and it's now $2.50, my internal assessment of that value is that it's gone up. Its value to me is increasing. This is one of the problems with averaging down. People perceive that when things fall in price, that their value to them increases. The logic flaw is this. If the value of something increases intrinsically as its price falls, at what point does it have infinite value? The answer is zero. Therefore, you should always wait until the price for stock gets to zero before you buy it. So there is this intrinsic flaw. I mentioned the drawdown in Domino's. Domino's has been falling for 3 years and is now down 80% off its peak. The market's perception of this is that it is damaged. And we come back to this notion, the simple question you ask yourself, if nobody else wants it, why do you? What special piece of knowledge do you possess that the market as a collective does not? What perception are you entertaining other than ego and thinking that you've discovered something magical? Do you have that every other participant in the market does not have. So let's do a thought experiment and say to ourselves, well, let's assume that we've got a Wayback Machine and we took the advice of Morningstar at the beginning of the year and we invested $10,000 into each of these stocks. This is what that $10,000 would now be worth. But I mentioned the notion of language. These recommendations, as they appear from these particular firms, are couched in a particular language. And that language matters because language influences software, which in turn influences decisions. This is why we use language to sell things. This is why ads are structured in a certain way to appeal to certain emotions. If we look further into this article, there's a few things about this paragraph that are interesting. It says here, Wesfarmers has seldom traded so far above our fair value estimate. So what's so important about the bit that I've highlighted? There are two things. Firstly, the use of the word our. This is corporate speak for avoiding responsibility. It is not my valuation, it is our valuation. Responsibility is therefore displaced. I used to see this all the time when I worked in the industry. People would not commit to a point of view where they did not use the collective as opposed to the singular. But there is all this notion of fair value. Who decides what fair value is? Yes, you can perform all sorts of metrics, but at the end of the day, the market gives you a price and says, that's fair value. If you think something is worth $5 and the market is telling you it is worth $10, then $12, then $13, then $15, your notion of fair value is wrong because the market is telling you it is wrong. Granted, markets are subject to bubbles and overexcitement and mania, but that's an irrelevancy because they offer the opportunity to take advantage of that and to make money out of it. There is also within language this tendency towards corporate wank speak, which is some strange attempt to make yourself sound cleverer than you are. And I've highlighted this sentence here. We expect the structural premiumization trend to counterbalance. If anybody can tell me what the hell that means, let me know in the comments below. But this is important. And it's important because it's an attempt to manipulate language in such a way that conveys a degree of understanding of the market. And just for shits and giggles, I thought I would generate a similar paragraph just randomly. The internet's full of wonderful little corporate wank speak generators. And so it generated this for me. This would sit perfectly within most annual reports from a company or indeed a report on a given company by an external group such as Morningstar. More jargon equals less clarity. And I don't know whether it is deliberate or whether it is simply one of those things that has crept into corporate jargon over the past few decades. So what's my basic premise? My basic premise is very simple and can be summed up in 4 words. You buy strength, you sell weakness. So how do we define that? It's actually very simple. And again, we come back to binary decision making so that there is no interpretation needed. You have the series of questions that are answered yes or no, not maybe, sort of, could be, and then couched within terms of some form of narrative where you attempt to convince yourself and others that you're correct. Is there more red than green? There is more red than green. Has price broken through some form of support? Yes, it has. Is it below its moving average? Yes or no? So we summarise this as buy strength, sell weakness. This separates guesses and feelings from data because data is the centre point of our decision making. The notion of value is a guess and a feeling, which is why the language is the way it is. Nobody's opinion counts. Only the market counts. If the market tells you something is worth X, that's what it is worth. You may have a different interpretation, but your idea of what something is worth is bullshit. Mine is, everybody else's is. So we loop back again to this notion of, what does the data tell us? What is the endpoint of our series of yes-no questions? Is the endpoint of our yes-no questions to be a buyer of something, a seller of something, or to stand aside?